Hey, EM family, it's Sean. I want to go over quickly on hedging. Of course, a hedge is basically just insurance from a downward move. No different than if you were to buy, insurance for your car, or more likely, what I like to compare it to is if you go on a vacation to Mexico and you want to buy some traveler's insurance. You're only going to have traveler's insurance when you need it. So, although I tend to have some sort of a hedge on at all times because you never know when the market's going to go against you, some people may choose to not have a hedge in place. So, the example would be after this large move down over here that you see, this is relative to the SPY. Somebody say, well, I don't need a hedge for a while, and that's fine. You can make that decision. That's a personal decision. I don't fully hedge at all times. However, I probably do have some sort of hedge on at all times. So having said that, is the first thing you got to decide of is what is your portfolio made of? Now we're all long-term investors, and long-term investors, we don't really care about short-term volatilities. However, it is important, I think, for us to have our finger on the pulse of that. I know Mr. Buffett says, he doesn't really care about a couple weeks, a couple months, but he's a billionaire, so he doesn't matter to him if his portfolio goes down to several hundred million of dollars. For me, I matter if my portfolio loses, five, 10, $7,000. So I want to try to hedge those positions. So what you have to do is you have to correlate your portfolio to an ETF because ETF is what we use to hedge our positions. So most portfolios are correlated to the SPY, the Qs, or IWM. Honestly, I mean, I have it on here and I can show you at some point, but I have this correlation map that it shows. There's really almost no difference between the SPY, the Qs, and the IWM. You can separate the SPY and the Qs are almost really their correlation is about zero point 0.7, zero point 0.6, depends on what time frame you use, which is pretty close for hedging. IWM is a little bit different. So for me, I'd use either SPY or IWM. Sometimes I use the Qs. But what you would do is I look at the chart and say, okay, what does the chart look like? Okay, so when you look at IWM's volume is dropping pretty significantly. So is the average. So the SPY you could probably use. Also, the RSI is dropping. This is just what I use. I use a few moving averages: 20, 50, 200-day moving average. This is a regression analysis with a 1.5, and 2 standard deviations from that. Regression analysis basically just says that for the past year, these are price closes, and it gives a best fit line. What that means is equal number of prices above it and prices below this line. And then from there, it gives you a standard deviation from that. And we know standard deviations, around 68%, then 95%, 97.5%, 99% for the 2 standard deviation move. Okay, so again, I don't use this technical analysis on my trading because I don't trade necessarily. I invest, but it's just knowledge that I have relative to the technical analysis, which helps me with my investing. So we're going to go with the SPY on this particular example. So let's say you have a $250,000 portfolio, and they're all stocks. If you have cash or you have bonds of any sort, then you subtract that from the value. So what you do is you would just determine what your value of your portfolio is. So let's say the value of your portfolio is $250,000. Okay, so you get $250,000. You're going to divide that by today. It is 417.75. Divide that by 417.75. That's going to get you 598. You round up if it's, like anything else. 551 or greater, you round up. 549 or less, you round down. So this is 600. So in other words, what this means is the notional value of your portfolio is the same as 600 shares of the SPY. So you're going to hedge your portfolio by selling 6 puts. Okay. So what you do is you go. This is going to be Thinkorswim specific. this platform that I use. So the first decision you make is what ETF you're going to hedge with. The second decision you make is what is your expiration period. Expiration period is simple. It's 30 to 60 days. You can fudge it, 25, 65, whatever, but I wouldn't go anything beyond 65. The reason for that is because the delta moves so sluggishly the further out you go that you're not going to get the protection that you're looking for. Some people may want to do this on a monthly basis. You want to be more active, so you can do it every 30 days. That's fine. Okay. So I pick, because I currently have a hedge on in June. You can see I have these hedges in place right now. Let me scroll down on the screen. The hedges are here. I bought the 403 and the 400. Okay. The market's moved up a little bit since I did this. You see my delta is 20, my delta is 30, delta is 27, right around what I'm looking for. Because your delta of the put that you buy is going to be between 25 and 35. That's in stone, 25 to 35. You don't fudge that number. Okay, you can move anywhere on that spectrum, but you don't go below or above that. Monte Carlo simulations have shown that these deltas give you the exact protection you're looking for, irrespective of volatility. Okay, that's what's important. Volatility only affects this trade based on the premium that you're going to get. Okay, there is some skew that's involved with this, and that's a whole other discussion. We can talk about skew. All skew is the price of the out of the money puts and the price of the out of the money calls, and there's a difference in that. Okay, risk is always to the downside, therefore there's always skew to the puts. So almost always you're going to find puts on products such as the SPY or stocks themselves. TLT and gold is different, but here you're going to find that it's going to be equidistant out of the money puts, out of the money calls. It's going to be more expensive for the puts because risk is to the downside. Okay, so we're going to pick again 25 to 35. So you look, you realize that as closer you get to the 35, the more expensive it's going to be. This is somewhere like 650, 649 to buy this one. If I go down to the 25 delta, you can see that it's 472. Right? I typically like to start in the middle, so somewhere around 830 delta, okay, like I got right here. So we're going to buy one of those, all right? So we got that, June 18th, buy one of those. Now, we have $5.63 is what it's going to cost us to buy that. Now, we sell a vertical call to help pay for that fully, or at least as close to fully as possible, so that it doesn't cost us anything. Now, we still have a margin requirement. Even in an IRA, there's still going to be buyer and power effects. There's still going to be some margin requirement, but it's not going to cost us any money for this particular trade. So what we do is we take this and divide it in half. So 250 in half. So $5 in half is 250, then 30 in half, so we're looking at 280. Okay? And the reason we split it in half is because we're going to sell two verticals to help pay for this. It's just a ratio that works out. Okay, so we got to pick something that's going to be somewhere between 270 and 290 is the credit that we're going to receive. So normally where you start at is if I sold or I bought a delta put of 30, you're going to go and find the delta 30 for the calls, and you're going to, for me, I hit the control key, and you see up at the top over here, these little sponsor keys come up right here. You can see, then I can just click on it and then build my trade. So we're going to go, I forgot. It's a 30 deltas. Look for the 30 deltas right here. So I'm going to go sell this. Okay. And then I usually try to start about $10 out from that right now, because the volatility the way it is, you got to go about $10 out. But the rule is, again, the delta on the puts are 25 to 35. The delta on the call that you sell is approximately the same delta of the put that you bought, although you can move that around as well. That delta range is the same as the put range, 25 to 35. Okay. So then you now go to what put or what call you're going to buy. The call that you buy is going to be somewhere between the 10 to 20 delta. and typically 10 to 20 delta. If I go 28, let's go to 38, you can see it is a 15 delta. Okay, so let's try this right here. We're going to buy this. Now you look down at the bottom of the screen here. I built this trade. It still is a 299 debit, but we got to sell two of them. I'm changing to two of them. Okay, now I have a 37-cent debit. Okay, that 37-cent debit is too much. I want somewhere between a 10-cent credit or a 10-cent debit. That's where I try to set these trades up. Okay, so what I can do is I can move these things around. So if I have a 28, let's say I want to go to a 39. What does that think? That's an 8-cent debit. Now it's $11 wide here, and this costs 11 cents. It's close. Okay, close enough. So that's the ratio here, as you see, is buying one put, selling two calls, buying two calls. Again, the ratio is 1 to 2 to 2. How I like to say is as I'm buying one put and I'm selling two vertical calls against that put. All right. So because I have a notional value of 600 shares, I have to increase this to 6. You watch these, so it's 6. So now I got 6 puts that I am buying, but now then I got to double this. So 6 times 2 is 12. So then I'm going to sell 12 of these. I'm going to buy 12 of these. Things don't change. Still have an 8-cent debit. It's going to cost me 8 cents for this trade. Now, in Thinkorswim platform specific, we have this thing called an analysis tab. Analysis tab is here. Okay, so here's the analysis tab. Why is this important? It's important because it shows me what my protection is and what I will gain or what I will lose on this. Now, mind you, when you pay your car insurance, or you pay your health insurance, or you pay any kind of insurance, you don't get much back for that unless you utilize it. Okay, so you have to remember this is basically buying insurance, buying protection for your portfolio because you see a potential market going down and you want to protect your portfolio. Because we're long-term investors, I'm not interested in my portfolio losing too much value in the short term, so I want to hedge that portfolio. Buffett does this as well. It's not very announced very much because he's a big-time put buyer. So having said that, we look here, and this shows you, this is today's graph. Now the blue line or the blue-green line, whatever you want to call this color here, this represents at expiration. So Friday, June 18th, because we know right here, June 18th is the expiration period on this right here. Right at 3 o'clock, well, it's 1 o'clock for me because I'm in Las Vegas. Right at 1 o'clock when the market closes, this is what that graph would look like. So whatever the price was, this is what it would be. This is what your loss would be or profit would be. Okay, but you can't gain your profit unless you close your positions out. Okay, so this lets you see that should the marketplace move down, let's say 10%, which is $4, so you'd be around 413. Come around here about 413. Look over to your left of the screen, bottom left, right here. Okay, you can see what your so 413 right in there. You can look over there and see that this would gain you $258. If it moved down that far today. Sorry, I kind of confused myself with this right because it's like, oh, that's not not true, but it is because of the period of time that this would be taking place. Okay, let me go. See, the date is at expiration. So let me go to today's date, the 28th. Okay, so here it looks much better, much cleaner, right? So you can see, should the price move down to 413.41, you can look over to the other side of the screen. You can see that you would get $1,677 if it was to suddenly move down 10% today. Okay, and you can play with that. All your percentages that you have, it only moves down here. I've got $594 if it moves down to 416. All right, and of course the reverse is if it was to go up, you can see your loss that you would sustain. However, you have to remember that when you buy or you place this hedge, it's protecting you to the downside. It does limit your upside to some extent, but not there's not a 1-to-1 ratio where you're going to lose. If this goes up, your portfolio is going to lose money. No, it's not. Okay? Because this is not fully eliminating your loss to the downside. Okay? So if you were to lose, in this case, $3,600, can guarantee to you probably more than likely your portfolio has gone up. If the market goes up to 426, your portfolio has probably gained $7,000 or $8,000 on this. Well, people are like, well, I don't want to lose that $3,000. Well, okay, well then don't hedge. Then when the market drops all the way down to, let's say, 410, you would have gotten 31.57 on this hedge, and your portfolio has probably lost, let's say, $6,000. So you take a $6,000 loss and hedge it and then cut your loss in half. Or to the upside, it's not quite the same ratio, actually. The ratio is more like a 1-to-3 ratio. So whatever you would lose going up, you probably have gained that by 3. So anyways, that's what this hedge is for. All right. Now, closing this hedge. You see how we put it together, now closing the hedge. The hedge closing is that's these times are pretty much in stone as well. So you need to close this hedge at least the last week within 1 to 2 days of expiration. Okay. The range of it is about 7 to 2 days, 2 to 7 days before expiration. You should close this hedge up. All right. Do not take this hedge to expiration. Do not allow this hedge to expire. If you allow it to expire, it's just if you're it's just not a good idea to do this. You should always close your risk. The risk that you have in this trade is the short call. Okay, what I mean by that is the short call is set where you can get they can call the stock away from you. Okay, so if you don't close this and the expiration occurs, mind you, expiration, you can't trade it after 4 p.m. or 1 p.m. my time on Friday, but it doesn't close until Saturday the next day. Well, you don't know what's going to happen in after hours trading. Let's say the market closes and then at 1:10 p.m. the United States starts dropping bombs on somebody, or somebody starts dropping bombs on the United States. You have another 9/11. You don't know. I know it sounds far-fetched, but people who weren't hedged when 9/11 occurred wish that they were hedged. So we can never tell the future. So you just need to be prepared. Just like you buy car insurance. You don't have the expectation, I'm going to go out and wreck my car today. However, you have car insurance. Okay? So that's what this is designed for. So you don't want to hold it through expiration. There's many people who have experienced this. I don't know anybody personally. I've just read about them who allowed hedges to expire without closing them out, and then some catastrophic event happening before the true close of the position, which isn't until Saturday morning. And then them find out that they're in a bad position. So they didn't want to close that out. I would definitely, you bought the put, I would sell the put to close the put, and I would buy the call to close the call, because you're short a call, you're long a put. I would close those two positions out. You don't necessarily need to close the long call. Um, However, definitely the other two that you do need to close. And again, that needs to be done within 2 to 7 days of expiration. So that's it on how you hedge. I'm willing to answer any questions anybody has. Email me or hit me up in the Discord. Thanks.